Markets are acting very erratic with huge ups and downs. There doesn't seem to be any end in sight for this. What could happen in short order is that the Fed will reverse interest rate hikes, engage in QE4, and actually go into the market and buy shares. But the likelihood of this occurring in the near future is not realistic. They will instead get to a point and realize that their quantitative tightening policy has in fact achieved their goal of slowing down the economy and will precipitate a new crisis. Welcome to the near future. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the stock market. I've got a whole bunch of different issues to discuss today, so let's begin by taking a look at Apple stock. This has come down here. There are new reports that are being unveiled suggesting that the sales are going to come down and so on. It doesn't really matter. I'm just showing you the progress as it happens here. You can look over the last month. This stock has not done very well along with most other stocks out there. It has declined along with the NASDAQ index itself. Looking at Amazon, this has also come down, going back to levels we haven't seen for 6 months. Both of these stocks are below the $1 trillion mark. So they were both above that. Amazon just for a short period of time, Apple for a little while longer, but they are both down quite a bit from their peak, that's for sure. Hedge funds that rode the technology wave up are getting bruised on the way down. This article, I'm not going to get into all the details, but essentially looking at all the hedge funds, how they have been adding to their positions of tech shares over the last little while. And throughout 2018, they've been getting beaten up. All right. They've not done well as a result of what has happened with the tech shares. That's, there's more detail in there if you want to read about it. But I want to move on to this. Technology stocks have sunk around 10% in just 1 month. For investors burned by the trade, one top technician says that the group is still safe to own. I'm not going to mention the individual's name, although you can read it right there. I don't want to bash the guy because I know that this is the general feeling of the market, and he is just one more investor that is looking to try to make a profit from what's happening. Okay, that's all. Technically, we've been able to recoup a lot of the damage that's been done over the last couple weeks. And so this particular tech sector ETF is still an area you want to be in near term. I'd look to buy any dips that we're seeing, thinking that into the midterms through November, December, we could see some further upward progress. If you look at a chart that goes back 5 years, that goes back 10 years, that goes back 1 year, you're going to see such impressive results throughout these markets that you're going to want to put your money in. And I understand why that's the case. For a technical trader, you see the day-to-day moves. You don't care about tomorrow. You don't care about next week or next year or next month. It doesn't matter because quite frankly, you're in and out. Okay, that's a technical trader. But what's odd about this is that he looks through here. If you look through here, you will see what he says, that you should own Apple because then you're going to get that dividend. I'd rather own Apple because I'll get a dividend and so on. When a lot of these technical traders, this guy is probably not even buying in for longer than a few hours sometimes. They buy in, they're selling. A lot of these technical analysts do not do what the average person does, what the retail investor does. And that's the problem with this. Okay, they're basically giving financial advice because a lot of people are watching CNBC to then make trades on the data that's presented to them. So they go about this suggesting to individuals out there, this is a good buy, that's a good buy, and people go in. Meanwhile, these technical traders, they don't do what individuals do. They buy and hold for basically forever until they need the money and they have to sell it off. That's what I don't like about this. That's why I never give financial advice, and that's why I stress to people that you need to do your own due diligence. Don't watch these channels and take advice from people you see on the screen because they're bought and paid for sometimes. You don't know what they're talking about, okay? You don't know what they're really going on in there behind the scenes. So that's all I wanted to show you with this. And that, I'm not even suggesting that tech is not a good buy. I think, and I've said this many times before, I've done entire videos about this, that you will probably see the tech shares be the best performers until the very end of the cycle. And that's just generally the way it goes. That's what happened in 2007. We saw the market coming down. Tech was the last one to rise for the most part. And it could certainly be the case again this time around. I'm not suggesting one way or the other. But it is a possibility because that's where most of the central bank quantitative easing from around the world has been going. It's been flowing into the tech shares primarily, and that was basically my point. Spotify to conduct up to a $1 billion stock buyback. This right here shows us that this is yet another company that's buying back their shares, adding to the $1 trillion plus that is planned in 2018 alone. Okay, so this is just one company that has been, up in the air for the last little while, along with other stocks too. There's more to this if you'd like to read about it, but I want to move on to Warren Buffett. They're sending a strong signal to the market with Berkshire's $1 billion buyback. What I want to tell you, what I want to ask you is, what do you think if a guy like Warren Buffett is sitting on billions of dollars of cash, and he decides to use that $1 billion in this case, to buy back shares of Berkshire Hathaway instead of buying $1 billion of Apple, instead of buying Amazon, instead of buying one of these other FANG stocks, or maybe buying into something else, GE, for example, which has been pushed down. Why not? Why hasn't he done that? I mean, that's anyone's guess, right? They're sitting on a lot of cash. They have the opportunity. They could be getting a dividend from some of these stocks, and instead buy back their own shares. Okay, so you fill in the blank on that. I'm just letting you know that this is what they've done, and I'm going to show you this bottom part. Berkshire was actively buying other stocks between July and September. Net purchases of stocks through the first 9 months of the year was $24 billion, nearly double what the company bought through June. So you'll see the significant purchases that have taken place at Berkshire Hathaway. They've been buying a lot, and so maybe this time they felt it wise to buy up their own shares instead. Okay, I don't know what's going on, but I'm just showing you that. What I wanted to also note from this was that we have the case here where they're showing us their filings from their 13F. That's public information. You could see what these companies are buying. Okay, so I'm going to do a whole video about the Swiss National Bank and other central banks, what they've been buying up. I will bring that information to you as soon as it's released. I checked today, still hasn't been released. I will periodically check back to make sure I get you that data as soon as it comes available. We want to know where the big money has gone. Of course, we're always getting it in a delayed fashion, but at the very least, we can see it for what's happening. Okay, then we can make that judgment. Market boogeyman may come for bonds, not stocks. Risk parity funds don't seem to be behind this month's equity rout, but are stocking up on bonds again. This is what a lot of analysts have been talking about, that we should be looking at the bond market, not the stock market. I think it's all interconnected, but here we are. Bond buyers, percentage of portfolio leverage allocated by risk parity funds to each asset class. And you could see that they're definitely stocking up on the bonds right now. They're selling off on some of the equities. Let's move on to the further part of this article. Risk parity funds are one of Wall Street's favorite boogeymen during stock sell-offs like the recent one. In this case, though, the worry should be in bonds, not stocks. The S&P 500 was down 6.9% in October. Its worst month since September 2011. Many investors were unsure why and blamed funds that follow rigid rules requiring them to sell in a downturn. Unlike in the February sell-off, though, risk parity funds didn't have many stocks to sell. Instead, it is their large stash of bonds that investors should fear. So we have something going on right now, and I just wanted to bring that to you. They get into some of the details of the risk parity funds. They're talking about it. For those who are interested, I just want to move on though. Lowe's to close 51 stores, including 20 in the US. It's happening in Canada as well. Right now we are seeing this, and why? Is it because of Home Depot? Is it because we have some issues with this particular company? Maybe to some degree, but I believe that it is the economy in general that is weakening. We see that there are housing inventory building up right now. Perhaps there is ultimately, on the whole, less being done today than there was just a couple of years ago, and I think that that's having an impact. It's going to be slow. We see a lot of other stores are closing as well. A lot of retail stores, of course, but it's not just retail. And this happens to be one example of that. But it is just something that I wanted to note to show you as all of these store closures are taking place. I need to cover that for you. This article is talking about David Stockman. He had some interesting points to make. The trade issue is not remotely rational. If this dispute worsens, it's going to hit the whole goods economy with inflation like you've never seen before, because China supplies about 30% of the goods in the categories that we import. And that's why people need to understand what's happening with these trade issues, that it isn't one-sided and that there's so much involved. We are going to be in a recession, and we are going to have another market correction, which will be pretty brutal. I do agree with that. As for when, you decide. And then this is a chart just showing us what's happening as the PMI in China is declining to levels we haven't seen since 2016, just showing us now the weakness that has prevailed in this country, as well as others too. It's not just China. We could see weakness going on all over the place. And eventually that has to finally be admitted by governments. Remember that in the previous recession, the government didn't admit that there was a recession until 1 year after it started. What does that tell you? They're not going to admit it when it's happening. It's going to be way down the road. And they're going to say, oh, by the way, you remember that event that happened? Yeah, that's the official beginning of the recession. Oops, sorry. And you're meanwhile on food stamps, your neighbor's on food stamps, you've got tent cities all around, but then you have other people living in these castles that seem to have never-ending flows of money, and it seems also wonderful for them, not for the rest though. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education that you were not taught in school, well then, these two books have it all. You can actually flip through these books. If you go over to Amazon, there's a look inside feature that's going to allow you to flip through the pages of these books to see if you like them. If you're more interested in the audiobook version, you can get that at themoneygps.com.